Good morning, everyone. I'm Vince Lanci. This is the Gold Fix Market Rundown being recorded at 7:30 a.m. Morgan Stanley calls the top for now. That's our main topic, referring to gold. And second, we do a little bit of a post-mortem or an update on China demand, because that is key to keeping this market stable on the downside. And the early signs are that things are good. So we'll touch base on that for a little bit. We're still developing it. All right, so here we go. Those are the two topics. And there's our homepage. Love that picture. I'm going to leave it there until it cracks the China demand. US 10 years are down 2, yield 445 and change. The dollar is 101.56, down 21. S&P 500 is 58.30, down 18. The VIX is 1859, up 21. Just look at the financials there. Everything there is a minor unwind of what happened yesterday. So it's a retracement, it's a correction, it's profit taking, whatever you want to call it. It's a counter to what happened yesterday. Gold, same thing, 32.55, up 21 and change. Silver, 32.99, up 40. Was up a lot more, but good sign when the gold-silver ratio comes in a rallying market, in a selling off market. That's an alert for just to stay away, right? So this is healthy. Okay, copper 462, up 5 cents, consistent with silver. That makes sense. WTI 62.56, up 45, another 45. Natural gas 357, 358, offered down 3.5. Bitcoin 103 spot 500, up 800. Palladium 950 up 260. Platinum 992, up 18. Interesting. I wonder if the palladium sell-off relative to platinum has to do with some sort of Russian thing. Gold, silver 98.64, maybe cracking. Really, maybe cracking. I think there's a lot of gold, silver that needs to be unwound. Soybeans 10.56, down 3.5 cents. Corn 4.36 and change, offered down 3. Wheat 5.10 spot 10, down 7. Wheat getting bludgeoned. All right, where were we? Here we are. All right. Today's analysis: Morgan Stanley argues for a trading range. The title of their report is Gold, Risk On, Risk Off. It's a good report. Lots of charts that are basically industry updates. Probably what's most interesting is their path prediction from where to from here type of thing. Anyway, the report is basically this is our notes here. After touching 3,500 an ounce intraday in late April, a $500 per ounce rise in about 9 business days, Morgan Stanley notes gold has settled into a range which they expect to hold for now. The key takeaways from that report are: 1, uncertainty on tariffs and global growth supported gold prices via investment demand, with very strong ETF flows through Q1 and most of April. 2, but high prices are starting to hurt gold demand elsewhere, with jewelry demand falling and central bank purchases slowing. And 3, for gold to keep moving higher, investment demand and uncertainty need to stay high as gold faces competition from other asset classes. Everything they're saying there is true. So let's go through these one at a time. Uncertainty on tariffs and global growth supported gold prices via investment demand. Right. Risk off, buy gold. American ETFs were buying that as they were getting out of stocks. But now they're getting back into stocks. And if it moves with a stronger dollar, they're going to sell some off. So the point is valid. But high prices are starting to hurt gold demand elsewhere, with jewelry demand falling and central bank purchases slowing. All right, we're going to push back on that. They see things we don't, mind you. But high prices are starting to hurt gold demand elsewhere, with jewelry demand falling. That is a direct comment on China, and we've seen that in other places. Jewelry demand is falling because the price is high. but ETF demand in China has exploded by 4 times. So as the Chinese investor at the margin thinks about buying some jewelry or buying an ETF, he buys the ETF now. Now, it's not really a fair comparison, but the reality of it is the growing, burgeoning middle class in China buys gold, and they buy it in jewelry form for one reason, because they have a historical mistrust of the government. But as that fades away, they're going to buy ETFs. All I'm saying is that the jewelry demand is definitely being hurt by the high price, but it's being cannibalized by the ETF demand. So it's really not that big a deal. I mean, who's talking about jewelry demand when central banks are buying like shit tons of gold every day? The jewelry demand is just whatever. They're not going to sell it. Maybe they are. Central bank purchases are slowing. Now, there's a big divergence here between, say, Goldman Sachs and other banks, and I would suspect that Morgan Stanley is probably the bank that keeps pushing back against Goldman Sachs's central bank demand is not going anywhere. And here's what I mean. Central bank demand after the election was perceived to be decreasing because the election's over, et cetera, et cetera. But then the tariffs kicked in, and central bank demand continued through that time frame, and then the tariffs kicked in, and central bank demand has surprised Goldman Sachs, and they adjusted higher. It has surprised Bank of America, and then I wouldn't know they surprised them, but it has surprised. Bank of America took note of it enough to look at how much gold would be bought by central banks over a time frame to neutralize their risk. So when you say central bank purchases are slowing, if you are saying that the urgency of the buying has decreased somewhat, I could not disagree with you. If, however, you're saying that they're slowing down to not buy over the long run, I would disagree, simply because the world is to various speeds de-dollarizing, and the de-dollarization means your central bank reserves need to be diversified, right? And so that means, for example, Bank of America says 30% is optimal for the central bank reserves, and they're like 20%, depending on who you're looking at. And Goldman says, hey, you know what? China and the other central banks are buying more than we thought they would. So they start to slowly uprank. Anyway, I'm not saying this is a stale opinion, but I am saying it's a divergence between some banks and other banks. And I would not be surprised if some banks are long and other banks are short. 3, for gold to keep moving higher, investment demand and uncertainty need to stay high. Yeah, that's right. That's right. As gold faces competition from other asset classes, right? As gold faces competition, yeah, we know that. But that the yields are not a competition for the last 3 years. It really comes down to the physical demand. So investment demand and uncertainty underpins your ETF purchases. Okay. So what has driven gold this last, say, $500 has been the anchor supporting it of, say, China insurance demand